Hello class, this is Dr. Fenton. In this video, we are going to look at financial statement analysis. Now at this point, you know how to prepare all 4 financial statements. You understand more about the numbers within those statements. And you know how to, prepare a lot of journal entries. So let's take a step back, look at the statements, and try to analyze some of those numbers in those statements. So let's get started. This is just some general information here you can read. And let's look at this one, vertical analysis. This is one way a company can analyze its own financial statements and maybe just look and see how it's doing overall, maybe from year to year, or to compare itself with another company. Now investors might do the same thing when they're thinking about buying stock of one company versus another company. They can go through and analyze the income statement and balance sheet. So vertical analysis is very easy to compute. For the income statement, what you do is take every number in the income statement column and divide by net sales. So net sales, 4825 divided by the same number, of course, is 100%. Cost of goods sold, 2585 divided by 4825 is 53.6%. So take every one of these numbers, divide by net sales, and you'll get these various percentages. These are the numbers for Under Armour. Of course, these numbers are in millions of dollars, so net sales will be $4.8 billion. Here are the numbers for Nike. Nike is way up there at $34.3 billion in sales. And its net income is $4.24 billion. Whereas Under Armour, its net income is only $257 million. I say only, well, that's still a lot of money, but compared to Nike, it's a much smaller company. What these percentages will do is allow you to see various things about the different numbers here. Now, an important number is gross profit and gross profit percentage. So if you want to know about the markup, in other words, for every $1 in sales, after you get the inventory cost covered, what is the gross profit that we can use for other expenses? So out of every $1 in sales, 100%, we have 46.4 cents of gross profit. For Nike, they have 44.6 cents. What this tells you is that Under Armour has its product marked up a little bit higher above cost than Nike. So 46.4% compared to 44.6%. Now, of course, actual dollar-wise, we're looking at $2 billion compared to $15 billion, but this allows you to see more how each company is doing within its own company. Drop down to the bottom number. This sort of reverses things by quite a bit, really. Now, for Under Armour, for every $1 it has in sales, pure profit, net income, is 5.3 cents. Nike, for every $1 in sales, then its net income is 12.3 cents. So I'm converting these percentages into cents, pennies, to sort of give you an idea of what's going on here. But now you can see that even though Under Armour has a higher gross profit percentage, Nike is doing a better job at the bottom line. So if you say for every $1, it creates 12 cents in profit, whereas Under Armour, for every $1, creates only 5 cents in profit. So that's one way to analyze these. You can compare companies, or the same company year after year. This is the income statement. Now, the vertical analysis of the balance sheet is just as simple to compute. But what you'll do here is take all these different asset categories and divide by total assets. So current assets, again, this is $1,965 million divided by $3,644 million. Then this shows you that in the balance sheet for Under Armour, 53.9% of its assets are in current assets. Nike has a higher percentage in current assets. Here is an unusual item. Under Armour has 17% of its assets tied up in intangible assets. I haven't looked at the statements to see what these are exactly. I would guess this would be copyrights, patents, and so forth. Whereas Nike only has 1.8% of its assets tied up in intangible assets. So this, again, allows you to compare companies and see how much of its different kinds of assets it has compared to total assets. Same way in this area, you can see that as to current liabilities, 18.8% of this section of the balance sheet is in current liabilities. Here we have 25. Compared to Nike, 23% in current liabilities, so a little bit higher. Common stock, this shows you Under Armour is financing its company through sales of common stock by 22%, 22.6, whereas Nike is up to 37.2. And then retained earnings, percentage-wise, Under Armour has retained more than Nike. Of course, dollar-wise, it hasn't because Nike is a much larger company. This allows you just, again, to see where the assets are tied up and what percentages. So instead of getting lost in all the millions and billions of dollars here, convert them into easy to understand percentages, and it's much easier to interpret what's going on within the balance sheet. So that's vertical analysis. Now horizontal analysis, what we will do is take the same company. So we don't have Under Armour and Nike in this one. You don't do that. You have the same company over time. So we're looking at Under Armour's numbers for 2015, and then for 2016, we subtract and find the difference. So net sales, 48.25 minus 39.63 gives us an increase of 862. Of course, this is in millions of dollars. This is a 21.8% increase. And you do that for each one. You take the latest year, subtract the earlier year, and then divide by the earlier year number. So you'll divide 862 by 39.63 to get the 21.8%. Net income, subtract, you can see this is 24. So 24 divided by 233 gives you the 10.3%. So its net income went up, it increased 10.3%. So it shows you for the same company what has happened over time. That's the income statement. Balance sheet is very similar. Balance sheet, what we will do, get it right here, we will take this year's numbers, like current assets, subtract last year's current assets. The difference is 466 positive. Divide 466 by last year's numbers, and so current assets went up 31%. Property, plant, and equipment went up 49%. That was a huge jump in property and equipment. And total assets went up, 27%. Over here, we have current assets went up 43%, and everything else you can see is going up. So you can see all the different percentages and how they increase. So again, comparing the same company over 2-year period, you have the base year, last year, the current year, subtract, find the difference, divide the difference by last year's numbers. And of course, keep your plus and minus signs correct. This intangible assets went down $33 million. So negative 33 divided by 661 is a negative 5.0%. So its intangible assets went down 5% from 2015 to 2016. So again, just another way to analyze numbers in the financial statements. And here's an example you can look at yourself. Now let's look at ratios. Really, there's nothing new in these ratios. We've seen ratios throughout a lot of the previous chapters, and this is a review of those ratios. Here are the numbers we'll start working with in these statements. And here are what we call the risk analysis ratios. So the risk ratios will be liquidity and solvency. And liquidity, it sees how, and we've seen this ratio before, both of these two, well, really all of these, I guess. But how quick are you collecting your receivables? So if you remember, that is net credit sales divided by average accounts receivable. That was back in Chapter 5. Then we immediately calculated average collection period, 365 divided by this ratio, and that gives the number of days. Inventory, how quick are you turning inventory over, and how many days on average do you hold inventory? That's what this will show you. The current ratio, you're trying to look and see if you have enough current assets to pay your current liabilities. So here's the formula. The asset test ratio, you're looking at your very liquid assets like cash and current investments and accounts receivable. How much of this do you have compared to your current liabilities? We take out inventory, we take out the prepaid items like prepaid rent, prepaid insurance. So in other words, cash and items that should be converted to cash quickly, how much of those do you have compared to your total current liabilities? Because you will need those to pay your current liabilities. Those are your liquidity ratios, part of risk ratios. Solvency relates to debt. Debt to equity, a very common ratio we talked about in Chapter 9. Total liabilities divided by total stockholders' equity. So you're looking at the right side of the balance sheet, dividing one section, liabilities, by the other one, stockholders' equity. Times interest earned ratio. This is always sort of an odd kind of ratio, but you're looking to see what income you have available. So income, add back your interest expense, add back tax expense, divide that by interest, and that shows you how much room you have in income to pay your interest expense. So the higher this number is, the better. None of these ratios are new. You can see the chapters where they came from. And now the examples down through here just shows you how to compute it. Again, we've done this before. Nothing new here. So you can review these when you have time. Now your profitability analysis. Again, these are all ratios we've seen before. The gross profit ratio, gross profit divided by net sales, return on assets, how well are you using your assets to generate net income, profit margin, net income divided by sales, how efficient are you in getting net income out of your sales? In other words, are you keeping your expenses low? Asset turnover, how are you using your assets to generate net sales? Return on equity, how well are you using the average stockholders' equity to generate net income? Earnings per share, again, probably the most commonly quoted number in the financial world for a company. What is its earnings per share for this year, for this quarter, or whatever? So we want to get it to a common stock number. So we take net income, subtract dividends on preferred stock, if you have any, divide that by the average shares of common stock outstanding. So again, a very commonly quoted number in the financial world. The price-earnings ratio, often called the PE ratio, very, very common number in the financial world. It's the then current market stock price for that share of stock divided by the earnings per share. And the higher the number this is, that means the more faith the financial world has in that company doing better in the future. Again, a more detailed explanation with examples, but nothing is new in here. Nothing here is new whatsoever. The only other thing in this chapter we're going to cover would be like discontinued operations. And what this means is if a company decides to get rid of one of its divisions, once that decision is made, and it might take several years for it actually to get to sell or dispose of that division, but once that decision is made, the numbers for that division, in other words, the revenue, the income, and so forth for that division, those are held separately from the other items in the income statement. I have an example down here to show you, like right here. So if this company, Federer Sports Apparel, has decided to discontinue the tennis shoe segment of its operations, then from that point, from that decision on, you show the net income, net of its own tax effect, for that segment separately. Everything up here should look about the same. This is a very, slimmed down income statement. but this is income from continuing operations. Then this is the discontinued operation number. Then you'll combine those to get net income. But you need to show this separate if your company decides to get rid of a division. And I think that's it in here. The next page. Don't worry about this. And that's the end of the chapter. It's a very short video here. Again, this is a review. For the most part, all those ratios. We do have two new concepts in here, the vertical analysis and the horizontal analysis. All right, so good luck with your studies.